Four different massive companies just released their earnings report, and in this video, we're going to be looking at each of them. We have Texas Instruments, and then we have Visa. We also have MSCI, and then we have Tesla. Again, all four of these companies just released their latest quarter's earnings report, so we're going to jump into those reports and also be looking at some key metrics for these companies. So let's go ahead and dig into it. And the first one is Texas Instruments. We can see trading $165.47 per share, but they're up 6% in after hours. Let's go ahead and dig into that earnings report. We can see they saw Q1 non-GAAP earnings per share of $1.10, which was a beat by around 2 cents, and revenue was down 16.4% year over year, which was a beat by about 50 million. So revenue was down pretty significantly for this company, but they did still beat all earnings expectations. If we go ahead and jump over to our stock screener, and again, you can download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets at tickerdata.com, link in the description. But if we come up here and plug in TXN and hit enter, you can see all this data again will automatically load in thanks to the ticker data add-on. Now, the big thing we need to point out here is free cash flow per share. This company has been doing a good job over the past decade of generating growing free cash flow so they can reward their shareholders with share buybacks and a growing dividend payment. But look at this, free cash flow per share dropped quite a bit in 2023, all the way down to $1.49, when in 2022 it is at $6.47. Now, what's the reason behind this? Well, a few months ago, the management team at Texas Instruments announced they would be building new manufacturing facilities. Now, the problem with this is capital expenditures are going to skyrocket and be about $5 billion per year through 2026. And so because of this, we can see free cash flow has dropped pretty significantly for the company, and that remained true in their most recent earnings report. Now, here's the big payoff for the company. The new manufacturing facilities have the potential to lower chip production costs by 40%. And I think that's what has investors excited. Yes, we're going to see low to negative free cash flow for quite some time with Texas Instruments right now, but if they can make it and get these manufacturing facilities developed in 2026 successfully, we could see a huge spike up in free cash flow per share after that. Now, if we look at Texas Instruments from a dividend perspective, the 10 and 5-year dividend growth rates are pretty phenomenal, but we can see a huge spike up in the free cash flow payout ratio. And again, that's because their dividend payments exceeded the amount of free cash flow they produced in 2023. Obviously a pretty big concern for the company, but it is in management's plan. The next company that just released their earnings report is Visa, one of my favorite dividend growth stocks, currently trading at $274.11 per share, and it's up around 17% over the past year. And we can see after hours, they're up around 2.7%. And this company saw a beat on the top and bottom lines. They recorded Q2 non-GAAP earnings per share of $2.51, which was a beat of around 8 cents, and revenue of around $8.8 billion, which was up an impressive 10% year over year and was a beat by around $180 million. So this company continues to exceed expectations. And Visa also stated that their most recent earnings report reflected stable consumer spending, obviously something you want to see if you're an investor in Visa. Now, if we jump over to my stock screener, let's go ahead and plug in V and hit enter. And again, this data will load in thanks to the ticker data add-on. Now, there's a lot to like about Visa simply by looking at them on the stock screener tab. We're seeing a lot of growth on top lines when it comes to revenue per share, like we just saw with their most recent earnings report, and that has found its way to the bottom line with earnings per share growth and growing free cash flow. Again, one of the key metrics I love to see, especially as a dividend growth investor. They're also buying back shares rapidly, have a healthy debt to assets ratio, and the return on invested capital is quite impressive at about 29.8%. So again, a lot to like about this company, but here's what's really impressive. If we jump over to the profitability tab, come up here and plug in V. Again, this data will load in, and the first thing I have to point out is look at this gross profit ratio, right at 80%, and that's also in line with their 5-year and 10-year average gross profit ratio. This company is incredibly profitable. Most of the money that they make finds its way to the bottom line. So again, very impressive earnings report from Visa, and they are a high quality business. Now, the next company we're going to be looking at is MSCI, and investors aren't quite as happy with their most recent earnings report. We can see they were down 13.43% on the day. That is a massive drop. I can't remember the last time we saw this company drop by that much in one single day. They're now trading at $446 per share. Now, over the past year, they're down around 18%, and obviously that's because of the huge drop we saw today. Now, over the past 10 years, they're still way outperforming the market, up around 981%. This company has compounded at a high rate over the past decade. So what's going on with the company? Well, if we look at the Q1 earnings report, we can see they did beat on earnings per share. Q1 non-GAAP EPS of $3.52, which was a beat by about 5 cents. Revenue was up 14.8% year over year, but it was still a miss by around $5.89 million. Now you may be asking yourself, does that justify the 13.4% drop we saw? I would argue maybe not, but there is more to it. And we can see Reuters talked about this. Revenue misses estimates due to subscription cancellations. If we scroll down, we can see first quarter revenue fell short of market expectations on Tuesday as they were hit by subscription cancellation and a contraction in margins due to one-time expenses. And investors seem to not be too excited about that news. Now, if we go ahead and jump over to the stock screener tab, let's jump over here and plug in MSCI and hit enter. And we can see again, there's a lot to like about this company historically speaking. Revenue per share has grown at a healthy rate and they have been rapidly buying back shares. In 2013, their shares outstanding was about 120 million. Look at it as of 2023, it's all the way down to under 80 million. So they have rapidly bought back shares during this time period, which has helped boost EPS, revenue per share, and free cash flow per share. If we look at this company from a dividend perspective, let's go ahead and plug in MSCI and hit enter. And the dividend growth this company has seen is absolutely astronomical. 10-year dividend compounded annual growth rate of 43%. Look at that, 2014, paying out about 18 cents per share. 2023, $5.52 per share. So pretty incredible dividend growth from this company. They also have healthy payout ratios. So this company definitely has the potential to continue to increase their dividend payouts at a very high rate moving forward. I still think they're growing at a pretty healthy rate, but obviously investors didn't like this most recent earnings report. So I do have to ask myself the question, does this create a better buying opportunity for MSCI, especially if they're arguing that this was due to one-time expenses? In my mind, that means it's probably worth looking into this company a little bit more, and I may make a future video on them. Now, the last company we're going to be looking at is Tesla. Tesla stock, obviously everyone knows about it, has had a huge run up over the past decade, but the past year hasn't been quite as good, down around 12.61%, currently trading at $144.68, but look at this, up 8.32% after hours. If we jump over to their most recent earnings report and scroll down, we can see they reported Q1 non-GAAP earnings per share of 45 cents, which was a miss by about 5 cents, and revenue of $21.31 billion, down 8.5% year over year, which was a miss by $950 million. So they missed on the top and bottom lines, yet shares are still up quite a bit after hours. Now, why is this? And most people think it's due to a couple of different things. And if we scroll down, we can see one of the things that potentially sparked the share price up for this company. We can see right here, Tesla has said that it has updated its future vehicle lineup to accelerate the launch of new models ahead of previously communicated start of production in the second half of 2025. Investors seem to be very excited about that news. Now, if we go ahead and jump over to the stock screener for this company, plug in TSLA and hit enter. We can see this is a company that just within the last few years has become pretty profitable. Now, obviously, negative earnings per share for quite some time. 2020 was the first year they saw positive earnings per share, and in 2023, it bumped all the way up to $4.73. And revenue per share has been growing at a very rapid rate during this time period as well. Now, one thing to keep in mind, shares outstanding has been increasing, so you are getting diluted if you are a shareholder in Tesla, but it's also important to keep in mind if a company is considered way overvalued, issuing new shares could be a good way for the company to raise capital, and it could also be cost efficient. So there you go, those are 4 companies that just released their latest quarter's earnings report. I think all 4 of them are pretty interesting, and they're obviously making pretty big moves in the markets as of right now. So let me know in the comments down below what you think of each of these 4 companies. And like always, if you'd like to get access to any of my spreadsheets, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.